It's time for charting futures. Here's Abigail Doolittle. And Abigail, I mean, it's been a pretty choppy week for stocks so far.
You're right about that, Caroline. It certainly has been a choppy week. Monday, we, of course, started higher, then finished lower. Yesterday, mixed after choppy session. Today, we are looking at solid gains. Now, all of this at this point does have the S&P 500 up for a modest gain, up 0.4%. Earlier today, it was about flat after all of that as investors contend with all sorts of macro uncertainties, including rates, bonds until today falling. Of course, now we have oil falling as well, the Fed next week, juggling all sorts of macro factors. Now, that's been true over the last year and a half. Let's take a look at a chart that we've looked at a lot, and it's a huge range of the S&P 500. This is 2016 and 2017. You see a clear uptrend. That tells you the buyers were in control. They liked the fact that there was the tax plan and the idea that the corporate profit outlook was expanding. But then we hit 2018 and so many uncertainties, starting off with trade uncertainties and then the Fed. So we see these huge swings up and down. Nobody knows what's next, neither the buyers nor the bulls. Typically, this pattern turns out to be bearish because it reverses the uptrend that precedes it. So the sellers turn out to be stronger. Right now, we're in the middle of what could be a smaller broadening formation, which is this larger one. Now, the range itself isn't all that important. It's lots of whipsaws, headline driven. What is how it resolves. It does look like, though, we could see another move down back into the range before the range resolves for a huge move down or maybe higher. To talk more about this and certainly more near term, Eric Dugan of 3D Capital. Thank you for joining us as always for charting futures. And your position is so interesting because you really only hold positions during the day and you only trade E-mini futures. Or correct me if I'm wrong about those facts. Possible facts.
That is correct.
Okay, great. So what do you think about this bigger chart? Like, how would you put that into the context of the smaller moves that you're making in and out?
Well, the last time I was here, I'd indicated we're in a new volatility regime. That big picture that you just showed certainly shows that and is quite scary. Thankfully, the market's given the gift of time and price for investors to take warn and be prepared. And so you're always talking about the global relay race. So here is an intraday chart, multi-day chart of the E-minis in white, copper in orange, and the Nikkei futures in yellow. Talk to us about how this helps your strategy and your trading. Right. So we at 3D Capital Management want to make money when the stock market goes down and stand aside when the market is rising. That gives stock market investors the ability to reap the benefits of gains. How do we do that? We have to be able to identify strength and weakness. So we look at the world as a global relay race. The Nikkei is where the first market opens in the world. If you take a look at here on August 26th, there was a clear breakout in the Nikkei to the upside. Now, what's interesting about that, Abigail, is that day the market net change was down 1%. But if you looked at open to close, the Nikkei was up 1%. Fast forward a week, there was another clear breakout in copper on September 3rd. Again, the net change was minus 1%, but the open to close was up 2%. So those were clues to us that the S&P was going higher. We just stand on the sidelines, let stock market rally, and let the stock market investors reap the rewards of about 4.5% since about the last 2.5 weeks.
Okay, so it sounds as though you are modestly positive right now, which would mean that you are actually on the sidelines instead of shorting the E-minis. Is that correct?
That's correct.
So now let's take a look at why you only trade E-mini futures, because I'm not aware of any other. I'm sure that there are, but I'm not aware of any. And these are some of the reasons.
Yeah, really these are all great reasons. I'm going to fast forward to the end here with hedging. You know, we call it a smart hedge. Using the E-mini S&P is the best vehicle to make money when the stock market goes down, and we're able to adapt.
Better than ETFs, or
better than
options.
ETFs, better than bonds. I mean, if you look at bonds in the last 4 days, they've dropped 5 handles, right? So you try to diversify with another asset class, you're just adding more risk to your portfolio. We use the E-mini S&P. That's where the greatest risk is. We sell it when the market goes down. We step out of the way when the market goes up.